Hey everyone, welcome back to Corporate Decoder. Ever wonder what happens when an infrastructure company tries to juggle railroads, power plants, and even a little bit of green energy? Well, let's just say their latest report is a bit of a wild ride. Prepare for some unexpected twists and turns in today's episode. This quarter, FTAI infrastructure made a big bet on power and gas, and the numbers are showing it. But is it a gamble that's paying off, or a train wreck waiting to happen? We're diving deep into their latest financial filing to find out. If you are interested in knowing more about corporate finance and decoding the world of big business, then make sure you're subscribed and also join our Discord community linked in the description below. First, let's take a peek at the overall health of the company with a glance at their balance sheet. Accounts receivable. The money owed to them is up to $65 million from $53 million at the end of last year. That's a good sign, indicating more business activity. It is important to point out, though, that a lot of their current cash is actually restricted and cannot be used without limitations, and that amount has jumped from about $1,220 million to $97 million. Their property, plant, and equipment has also exploded to $3.2 billion, previously at about $1.7 billion. This huge jump likely means they have a lot of new tangible assets like machines and land, which has exploded now that they own that power plant. The debt to pay for those extra assets, however, also increased and is now at about $27 billion. Now, let's examine their income statement and see how all this translates to cold hard cash. They generated about $96 million in revenue compared to $82 million last year. Good jump on the surface. But it's important to also consider their expenses too. Operating expenses are up slightly to about $67 million, but the biggest jump has to be other income at $87 million. That jump is primarily due to a gain on sale of assets. You want operating income to be the primary driver of profit, so this is important to keep in mind. Ultimately, all this translates to about $120 million in net income compared to a $50 million loss last year. A major turnaround, and all those changes are reflected in their earnings per share. Basic earnings per share have jumped from a loss of 54 cents to a profit of 95 cents. The biggest gains here are due to the asset sales. Now let's check the statement of cash flow, since those numbers are often more insightful than what gets reported in the income statement. Net cash used in operating activities is about $86 million. This is a 2,000% jump since they were only at about $4 million previously. Ouch, that's not good. That means most of their profits are in accounting gains. What this tells us is that they may not actually have the liquid cash to pay back shareholders if they wanted to. Investing shows about $164 million provided from investing activities. This is also because of the acquisition they made. Lastly, cash flow from financing activities is about $2.5 million. It is very hard to tell what happened exactly, but they raised about $28.2 million in debt. So they are using both debt and cash to reinvest into these projects that are not generating income just yet. Let's scroll to the accumulated other comprehensive income table as it shows how derivatives are affecting them. We can see that it changed by about $160 million during this time period because of changes with derivatives. Keep in mind that derivatives are a zero-sum game, that $160 million IAS isn't free money. It means someone is going to be losing $160 million when these expire in the future. Okay, so a lot of that was numbers. What does this company even do? Turns out this report also gives us insights to their significant accounting policies. For example, what are variable interest entities? Basically, these are companies they have significant investments in but do not necessarily control. FTAI consolidates all entities in which they have a controlling financial interest and control over significant operating decisions, as well as these VIEs in which they are the primary beneficiary. They hold almost all the shares of the Delaware River Partners, and so DRP has been presented on a consolidated basis. As you can imagine, there is a lot of discretion on how much influence you have in another company. So this is something that has a potential risk, and Angeles in video V have a controlling financial interest and control over significant operating decisions. As well as these VIEs in which they are the primary beneficiary, they hold almost all the shares of the Delaware River Partners, and so DRP has been presented on a consolidated basis. As you can imagine, there is a lot of discretion on how much influence you have in another company, so this is something that has a potential risk. Goodwill, on the other hand, includes the excess of the purchase price over the fair value of the net tangible and intangible assets associated with different acquisitions like Jefferson Terminal and Long Ridge. They check the carrying values of goodwill at least annually to make sure that they were valued appropriately. They are pretty good at this since there was zero impairments to goodwill. So it seems like these wild swings in financial statements is because they bought Long Ridge Energy and Power LLC. Apparently they only previously owned a portion and now they own all of it. We can see more details about these assets and liabilities assumed in a table. A lot of this is numbers and it is really hard to verify what's going on. We can, however, see the assets and liabilities and make a general statement on if they are valuable, and as Warren Buffett said, it is far better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. This looks more like the latter. They have intangible assets worth just $1.5 million, but will depreciate after 15 years. It's a question if something like brand value is accurately represented. Their new assets have 1.5 B in property, plant, and equipment. So these seem to be some big properties that will continue to make them a lot of money. Long Ridge came with a cost, however. Total liabilities assumed are about $1.4 billion. That's not even including the $127 million of goodwill. There is more liabilities than value, so we can make a reasonably safe assumption to say it was not a good deal, even though their stated net income will look better now on paper due to their increased ownership stake. All of this has to be broken down into its 5 operating segments though. Railroad has about $42 million in revenue, while corporate and other has $13 million. So these are still major business drivers. Digging through these, Jefferson Terminal has a very solid 19.4 million arrive at. The final 109 million to admitting is very well for them, until they hit corporate and other, which reduces about $23 million in net income, to finally arrive at the final 110 million Ponenol men income, to finally arrive at the final $109 million net income, to finally arrive at the final 109 million net income. The power and gas segment uses derivative contracts to protect themselves from energy price fluctuations. All this is important because Long Ridge makes about $10 million in power and there needs to be a business in place to make money. So this is a great strategy to protect their overall financial earnings and protect the debt that they took out. Finally, for those not sure what temporary equity is, it is basically equity that could disappear in the future. That is the Series A senior preferred and B preferred stock. Alright, so we've seen the good and the bad now. Let's talk about all the things that could go wrong. There is always the simple and honest. We have limited operating history as an independent company that could lead to all sorts of problems. Basically, they can't guarantee success on their own. Macroeconomic conditions such as trade disputes and tariffs create difficult operating environments and so could lead to a reduction in future capital budgets. The risk from high concentration of few assets can adversely affect their business because all their eggs are in a few baskets. There is always the danger of spills to hurt both the environment and the company's reputation, not to mention potential lawsuits. And a disclaimer that I feel that I need to point out: all the great targets that the company sets are not forecasts, so it is important to realize they are not guaranteed numbers. As an external observer, it is very hard to prove with the company's internal policies are good. There is always the risk that they might not be, and there might be an accounting fraud happening. The language they use seems to indicate the risk. Lastly, there are conflicts of interest as their directors serve on both boards, so they have an incentive to favor what's better for both companies overall. Lastly, and most importantly, they state that the board can force payments on the A preferred shares, which effectively locks in payment towards those specific debts. Since a lot of debt needs to be paid, that means there will be no cash available for common stock dividend. These findings all highlight the high-risk business they are in, with a lot of assets and debt. Their revenue is actually not bad, but as we pointed out, they are not actually making money in cash to pay out investors. Ultimately, for the next quarter, it would be wise for investors to keep their eye on how they integrate their assets into their business and be careful of any stock price volatility due to all these changes. If you found this video informative, please hit the like button and share. Be sure to subscribe for more deep dives into the numbers. Don't forget to check out the Discord community linked in the description. Thanks for watching, and I'll catch you all next time.